Hey guys, Britt here. Welcome to End Times Bible Prophecy. Make sure to hit the subscribe, like, share, and restack buttons. Well, it finally happened. Something we've been talking about on this channel for quite a long time. I don't really know how long it's been. 18 months, 2 years. I don't know the exact amount of time. We've been talking about this. If you saw the video on the Substack on Saturday, you already know what I'm talking about. But I'm talking about this right here. So for quite some time, I've been telling people, well, how will we know when the financial crisis has arrived? How will we know when the depression is going to emerge into the headlines? Meaning, through the form of a crashing stock markets, through the form of a spike in unemployment, mass layoffs. Well, we're going to know when we see this number go positive, which it did for the first time in over 2 years at the market close on Friday. So again, this is the 2-year, 10-year spread, also known as the yield curve, and it measures the difference between the yield, what the cost of lending, what the government pays to borrow money for 10 years versus what it pays to borrow for 2 years. Typically, you would expect whoever's lending that cash to the government to want a higher rate to lend for 10 years because of the increased inflation risks that are involved versus for 2 years. But that's actually been inverted. It's been upside down for over 2 years. Why is that important? Well, historically, that indicates a coming recession, meaning when and if you listen to the media, if you listen to the mainstream media, they talk about it when it first inverts and they say, oh, well, this is a recession indicator. So they acknowledge it then, but they act as if the inversion indicates a recession is here, but it doesn't. It's when it un-inverts, as it just did on Friday. Again, we saw this un-invert intraday for a brief time on August 5th when we had the Japanese market meltdown. But this is Friday was the first day it closed in positive territory since July 2022, making it the longest inverted yield curve in U.S. history. And as I've been saying for quite some time, this is the indicator we really want to look at. That's when your ears should perk up. You should really stand back and say, what is happening? So we look at this over the course of the past 5 years. We see that it goes all the way back to July 2022 when it was last positive, which is what you normally see is this should be a positive number. Again, let's take a look over at the Federal Reserve Bank of St. Louis where they have this chart. We can pull up all their data that they give us goes back to 1976. They used to give us all of more data than that. But this is fine to have because really, to have an apples to apples comparison, we need to look at the post August 1971 system, monetary system, when Nixon temporarily, it's been 53 years, but Richard Nixon temporarily suspended the conversion of US dollars into gold, effectively creating this fiat currency system that dominates the world today. So as we see, looking at that, every recession, these gray periods right here indicate recessions that took place. So we can see the COVID lockdown recession there, the great financial crisis, the post 9/11 bubble burst recession, early 1990s, 1980, 81 recessions. All of these recessions were preceded by inverted yield curves, meaning this line went into negative territory. And after it went back to its regular positive territory, meaning an inverted yield curve, we either saw a recession occur soon thereafter, as we've seen here, 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 and here, or we found out we were already in a recession, which is what I think is the case this time. We're going to find out we've been in a recession, and we're in the grips of a global depression. If you watched the video last week where we talked about what's going on in China, what's going on in Germany, that indicates we are in the grips of a deflationary spiral in those countries. It's coming to the United States in the very near future, in my opinion. So this is what we're looking at. This is the big indicator. And I've said for months, wait for this to go positive. We want to watch it, make sure that it's positive for several days or weeks, potentially. But we want it to go more than positive for just one close. But we should be paying very close attention right now. I think this will stay uninverted as we approach September 18th, which is when the Fed meets and is expected to cut their Fed funds rate on that day, which may not have the outcome that the conventional wisdom thinks. This we'll address momentarily, but see, why is this important? Let's go look at this tweet right here from Macro Alf. He says, here we are after a prolonged inversion. The US yield curve just disinverted. Here is why it matters. It says many are familiar with the yield curve slope as the predictor of recessions. The track record is almost perfect, and there are good reasons why. And the only time I believe it wasn't was back here in the late 1960s. But this type of yield curve un-inversion does have a perfect track record, and we'll talk about that in a moment. But it says an inverted yield curve often leads toward a recession because it chokes real economy agents off with tight credit conditions, which are reflected in weak future growth and inflation expectations. So if you're a bank and you can get a higher yield by lending the US government dollars for 2 years than you can making a 7-year auto loan to a consumer, you're going to do that. And in other words, it's credit standards have tightened as a result, and fewer people are able to borrow, which has an impact on the economy. It says a steep yield curve instead signals accessible borrowing costs, feeding into expectations for higher growth and low inflation down the road. It says specifically a disinversion, which happens after a long period of yield curve inversion, is the macro signal, and I agree, that has historically indicated weak growth ahead. Take a look at the chart below. It's the disinversion investors should watch closely, not the initial version, which is what we always hear in the media. The media sees the initial inverted yield curve, says, oh, this is a recession indicator. The yield curve is inverted. And then after a couple of months, they say, well, there's no recession here yet. It must be wrong. It's different this time, right? They do this over and over each time this happens. Yet it's not different this time. It's the same. We're going to end up with the same issues we've had in the past. It says the historical pattern goes like this. Every recession in the last 50 years was preceded by a yield curve inversion. The timing between the initial inversion and the start of a recession varies. In the early 80s or 2000s recession, it was as little as 12 months. Well, in 2008, it took 27 months for the macro lags to appear. And we'll talk about what he means by lags in just a moment. But of course, as we saw in 1980 and 81, the recessions had already taken place. They were already in the midst of recession once we saw the un-inversion. It says in the final step, the yield curve disinversion happens, which we just saw this past Friday, and soon after, the macro lags kick in and the US economy slows down more aggressively. where are we today? He says the yield curve inverted for 27 months and now disinverting with the job market slowing down. The lags are particularly long in this cycle because of how the U.S. economy is structured. Fixed mortgage rates and corporate borrowing have shielded the private sector from these higher rates. The macro lags are long, but they have not disappeared. So what is he talking about when he talks about lags? Well, we've discussed this well in advance. 2 years ago, we were talking about this right here. So when we hear in the media that the Fed is going to raise rates or lower rates, this is what they're talking about. They're talking about the federal funds effective rate. So what we're looking at here is historical data going back to 1954 of where the Fed funds effective rate was set. So this is the interest rate that they're setting when we hear that they have those meetings. And as we can see, well, back in the early 1980s, it was 17.82%. So it's certainly been a lot higher than it is right now at 5.33%. So why are we looking at a situation where the economy could be in turmoil over rates being at 5.33 when, they've been much higher in the past? They were regularly much higher than that in the past. Well, as we pointed out at the very beginning, a couple of years ago, these actually are some of the highest rates in history, because when you look at the year-over-year percentage change, you get this right here. This is showing that starting from that near zero level, the percentage change and increase in interest rates was unprecedented. You have to go back to the 1950s. Previously was the previous record, July 1959, a 410% increase year over year. That was the previous all-time record. Well, we hit 5,612% in February 2023. Well, you might say, well, nothing bad happened in February 2023. Although keep in mind, 1 month later, we had the emergence of a banking crisis that led to the second, third, and fourth largest bank failures in U.S. history, as well as the near collapse of Credit Suisse, a global, systemically important bank that almost took down the global banking system. But other than that, everything was docile back at that time. But keep in mind, it takes anywhere from 18 months to 2 years for all of those effects of the raised interest rates to work their way through the economy. So think of commercial real estate when we've mentioned generally those are 5-year loan terms. Well, if you've still got 3 years left on that loan, that the rising interest rates aren't going to impact you until that 5-year loan comes to maturity and you need to roll it over and refinance at the higher rate. So it takes time for these higher rates to work their way through the economy. And the last rate hike, as we saw, was back in August of 2023. So we still got months ahead, at least until March, where we're going to see the impact of these rate hikes from the past still kicking in. Those are the lags that Macro Alf talked about in his tweet. So even if they cut rates on the 18th, we're not going to see the impact of those cut rates for 18 months to 2 years. In the meantime, we'll still see the impact of the raised rates for many months ahead. So that's what we're facing here, guys. Again, what does all this mean? Well, I believe it means we're going to see what we've been talking about become common knowledge, meaning the average person on the street is going to become very well aware. At first, the media will call it a recession. It is a depression. It's going to be very severe. But the average person will become aware of it when they see the stock market crash and they see a huge spike in unemployment and mass job layoffs, similar to Think of the great financial crisis. That recession began in December 2007, but most people were unaware until they saw Lehman Brothers collapse in September 2008, stock market crash that took place over the several months after that, and the mass layoffs in December, January, and February of 08 and 09. So the average person believed all the media stories that said, oh, it's going to be a soft landing. Don't worry about these, residential real estate problems and subprime mortgages. It's all contained. Everything's fine. Just the same thing they've been telling us about the banking crisis from last year. It's contained. Everything's fine. But of course, if you remember, Janet Yellen said that stuff and then came back later and said, oh, we thought the wheels were coming off the bus. There was going to be a bank run all over the world. Bank runs all over the world. But at the time, she said, banking system's sound. It's resilient. So we're in the midst of this right now, guys. Expect in the months ahead, not necessarily tomorrow, but in the months ahead to see massive job losses and a crashing stock market and a worsening economy. So what types of things will we see? Well, we had this from Zero Hedge from a couple of weeks ago. Remember, U.S. jobs revised down by 818,000. An election year shocker, second worst revision in history. And of course, there may be some electioneering going on to make the job growth look better than it is for the administration in power. But a lot of this is just government incompetence. We saw this during the Great Recession as well, where they had to revise these things because, shocker, the government doesn't actually go out and survey people, find out, do you still have a job? They don't go ask businesses like some of the private research firms do. They make it up. They have these models, and they have something within their model called the birth-death model, where they estimate and project the number of new businesses that will be birthed and the number of businesses that will die off and go out of business. They call it the birth-death model, and they go, yeah, the birth-death model created 100,000 jobs yesterday. They just make it up. And then over time, as the actual real data comes to light, they go, oh, we're going to have to revise this. So, you can't, I was going to say, you can't make this stuff up about them making it up. It's just preposterous. All this billions of dollars spent on these government agencies, and they just put this data out and they make it up. And so we found out just a few weeks ago, 818,000 fewer jobs than people originally anticipated. And then we had this from Twitter from Zero Hedge on Friday, where the government released August non-farm payroll data. The expectations were for 165,000 jobs created, or made up in August. Instead, it was only 142. But then on top of that, they came back and they revised July lower by 25,000 and revised June lower by 61,000, which has been something that's been ongoing. So between all of these expectations and revisions, there's another 100,000 jobs. So there's over 900,000 fewer jobs than what was thought just a few weeks ago, right? Because they make this stuff up. It's just unbelievable, guys. And then on top of that, we've got this from CNBC. This is from Thursday. It says layoffs jump in August, while hiring in 2024 is at a historic low, Challenger report shows. So Challenger Gray & Christmas is a private enterprise. I tend to believe their data more than this government data because they're actually paid by real firms in the real world to provide reliable data. So I would think theirs is more accurate. This article says layoffs soared in August, hitting their highest total for the month in 15 years. So 15 years, when was that? Oh, 2009, in the midst of the great financial crisis. while year-to-date hiring reached a historic low. Outplacement firm Challenger Gray and Christmas reported on Thursday. Announced job cuts totaled 75,891 for the month, lurching 193% higher than July. So we saw a sharp increase in layoffs from July to August, according to Challenger Gray and Christmas. So the total was just 1% higher than the same month in 2023. It was the highest number for August going back to 2009, as the economy was still escaping the worst of the global financial crisis. On the hiring front, companies said they were adding just 6,101 new workers, up by nearly 2,500 since July, but down more than 21% from August 2023. Year-to-date hiring announcements of nearly 80,000 is the lowest total in history going back to 2005. So they've been gathering this data for almost 20 years. The great financial crisis occurred in the middle of that. The Great Recession occurred in the middle of that. And this is the lowest total they've received. Quote, August surge in job cuts reflects growing economic uncertainty and shifting market dynamics, said Andrew Challenger, the firm's senior vice president. Companies are facing a variety of pressures, from rising operational costs to concerns about a potential economic slowdown, leading them to make tough decisions about workforce management. The report comes with concerns rising that the labor market is weakening, even though the U.S. economy has seen a growth of 1.4 million non-farm payrolls this year. So the made-up government data says there's 1.4 million new jobs. So please disperse. There's nothing to see here in this Challenger Gray and Christmas report. I mean, it makes no sense. The government's telling us there was 1.4 million jobs, but remember, with their birth-death model, they're just making it up. So we really don't know how many were created. It says payroll processing firm ADP reported Wednesday that private companies added just 99,000 workers in August, the smallest gain since January 2021, or over 3.5 years ago. Markets expect a softening jobs picture to prod the Federal Reserve into lowering interest rates later this month, even with inflation running higher than the central bank's 2% target. To be sure, the Challenger layoffs data is somewhat out of sync with government reports. Who would have thought? Which show that total initial claims for unemployment benefits, which is probably a more accurate indicator, have been slightly elevated in recent weeks, but not reflective of a major escalation. For the week ended August 31, jobless claims totaled 227,000, a slight decrease from the previous period. Thursday's report showed the biggest growth in planned layoffs came in the technology field, with companies announcing 41,829 job cuts, the most in 20 months. The labor market overall is softening, Challenger said. Companies announcing job cuts most often cited cost-cutting and economic conditions as the reasons. So let's take a look at this tweet by George Gammon in reference to this article. He said the highest level of announced job cuts for August since 2009. One, curve inverts. So the yield curve inverted 2 years ago. We've been pointing that out and saying when it un-inverts, look out. That happened on Friday. He says bull steepener, that's the type of un-inversion that occurred. Unemployment spikes. We're seeing that. Fed cuts rates, which they're anticipated to do on September 18th. So just a little over a week away from that. 5, recession. This time isn't different. It's literally playing out the exact same as it has almost every time going back to the 1950s, and every time in the last 50 years. So guys, this is all all your friends and neighbors will be talking about this 6 months, 12 months down the road and saying, can you believe this economic downturn came out of nowhere? But anyone paying attention to this data could have known. How about this? This was in Zero Hedge last Wednesday. It says a stunning chart ahead of Friday's jobs report, which we just found out was lower than expected. It says, we are referring to the historic collapse in construction job openings, which have tumbled from an all-time high of 456,000 in February to a four-year low of 248,000 in July, a plunge of nearly 50% in just 6 months, to a level the U.S. economy first reached back in 2016. So let's take a look at the chart they're referring to. It's this one right here. So the red line is construction job openings. So when you see, hey, we're hiring for this position, that's what that means. The green line is actual jobs in construction. And as we can see, they generally trend together. We see the red line is much more volatile. It's not as smooth as the green line, but when we see these big dips, the green line tends to go with it. Well, now we have this huge divergence. Nothing like it on the chart. The closest is probably right here and here. But one of these two is wrong. Based on the other data we're looking at, I'm thinking the green line is going to come more in line with the red line in the very near future. That's what historical trends tell us. So that's what we're seeing on the job front, guys. We're seeing a weakened job front. We're seeing rising unemployment. I think we're going to see a spike in unemployment in the months ahead. I don't know what the timing of that's going to be, but it wouldn't surprise me if it's 2 months from now or 8 months from now, but it's not going to be 5 years from now. We are in that place now that we've seen the yield curve un-invert, where we're going to see mass layoffs in the very near future. One of the reasons is just the weakening of the economy. Let's look at some of these headlines, like this one from CBS News. McDonald's sales are slumping because people can't afford fast food. I remember when we used to read headlines that said that's all people could afford. Oh, well, you know, these people on the lower end of the economic spectrum, they're having to eat unhealthy food at fast food places because that's all they can afford. Well, now nobody can afford that either. How about this post on Twitter from Golden Coast? It says, this is what an inflationary depression looks like, from the Dollar General earnings call. So this is the corporate earnings call for Dollar General. It says, I want to provide some additional context around what we're seeing and hearing from our customers. The majority of them state that they feel worse off financially than they were 6 months ago, as higher prices, softer employment levels, and increased borrowing costs have negatively impacted low-income consumer incentive. As a result, our core customer, who contributes approximately 60% of our overall sales, comes predominantly from households earning less than $35,000 per year. Inflation has continued to negatively impact these households, with more than 60% claiming that they've had to sacrifice on purchasing basic necessities due to the higher cost of those items, in addition to paying more for expenses such as rent, utilities, and healthcare, which I would say are basic necessities. More of our customers report that they are now resorting to using credit cards for basic household needs, and approximately 30% have at least one credit card that has reached its limit. In our latest survey, 25% of our customers surveyed noted they anticipated missing a bill payment in the next 6 months. And we're going to talk in a moment about another article that points out not only is it bad in general to be putting household expenses on a credit card, but that option isn't going to be available very soon. So let's take a look at this from Zero Hedge. It says, first Dollar General, which we just read about. Now the Dollar Tree shares plunge as both discount retailers warn of core customer under pressure. So this is happening It's not just Dollar General, or it's all of these companies. Like, here we go, Five Below. Goldman says Five Below's earnings indicate core customer is pressured and reducing discretionary spending. And if we scroll down to the bottom, which that's where all the good stuff in the articles is, it says, we note that Five Below continues to see diverging trends between income cohorts, with softer trends from lower income households. So we read before where, okay, well, Dollar General seeing their core customer under pressure, they can barely afford to survive, much less spend some discretionary income at Dollar General. But stronger trends from higher income households, suggesting some element of trade down is taking place. In other words, people who have higher incomes and generally don't shop at Dollar General are saying, I can't afford to shop, at Target or wherever they would shop, so I'm going to go to Dollar General now. Although the implied trade down trends are encouraging, we believe pressure on Five Below's lower income consumers will continue to weigh on conversion in the near term. So that's not enough to make up. And of course, those customers are moving from somewhere else. These are bad trends. How about this from CNN? 39% of Americans worry they can't pay the bills. It says many Americans regularly worry they won't be able to make ends meet. Nearly 4 in 10, 39% of U.S. adults say they worry most or all of the time that their family's income won't be enough to meet expenses, according to a new CNN poll. That's up from 28% who expressed those concerns in December 2021, and it's similar to the numbers seen during the Great Recession, 37%. Yes, it's similar, and it's also higher than what we saw during the Great Recession. But guys, we haven't seen the market crash yet. We haven't seen mass layoffs. How high will this number get? And we have this from The Guardian. It says, my credit cards, my spending limit was slashed by 90%. Of course, it's warning us this article is more than a month old. Well, yeah, it's almost exactly a month, August 3rd. But it says, it's a tale of two credit cards. Two members of the Guardian money team, so this is people who write for The Guardian, have had their Barclay cards for years. These are in the UK, if you're not from there, and both use them regularly and pay off the balance every month. Until fairly recently, both had a healthy credit limit, the sum available to spend on the card. Then in December, both received letters about those limits. Hillary Osborne's was increased. Rupert Jones had his slashed. We wanted to know what was going on and what it told us about how banks decide how much they will let us put on our plastic. And this is important. We just read that many Dollar General customers are using these credit cards to get basic necessities, and they're reaching their limits. They're not sure what they're going to do after that. We would expect to see, going into an economic downturn, these credit limits overall being slashed. This is what tends to happen as these banks look at the risk of loaning credit card debt in particular. It's unsecured debt, meaning, if you borrow cash to buy a car and then you don't make your payment, they repossess the car. If you borrow to buy a house and you don't make your payment, they repossess the house. And then they sell the house, they sell the car to try to satisfy the loan. But in the event of a credit card, if you say, nope, not paying, there's nothing they can do about it. They can ding your credit score, but that's about it. And so as a result of that, they tend to constrain and increase the stringency of the standards of who they're lending money to in poor economic conditions. So, for instance, during the Great Financial Crisis, we had a credit card that we didn't really even use. I think I had it from college. It was just sitting there, and I got a notice one day, canceled, right? Totally canceled. And Why is that? Because, it's not as if I was abusing that credit card in any way. But from their standpoint, what if that was my emergency stash of cash, my emergency fund? I went, well, if things get really bad, I've got this credit card here I haven't used, and it's got a $10,000 limit, and I'll just go buy what I need with that. Even if I had lost my job, didn't have a job, something like that. And so they look at signs like that, unused credit cards, and think, is this somebody's backup plan? we don't want to be their backup plan in case they lose their job. So since they aren't using it so much, we're gonna cut it altogether. We're just gonna end it. Or maybe they see, maybe you've got a $10,000 limit and they cut it to $6,000 or $5,000. So you're going to see that trend take place the further economic conditions deteriorate. How about this? We had this from Zero Hedge. RV downturn turns apocalyptic with largest dealership offering 55% discounts. So if you remember 4 years ago, RVs were selling like hotcakes as people were locked down in different states and different areas, and they wanted to go out into more rural areas or even work from the RV and travel the land. Well, now it's the exact opposite. It says the RV bust has now persisted beyond the 2-year mark. And to understand the industry's current environment, look no further than Lazy Days, an RV dealership with over 24 locations nationwide, which bills itself as the world's largest. The company recently reported significant revenue declines and sluggish sales with no immediate recovery. And we see here it says with discounts up to 55% on RVs at their Lazy Days website, a remark about maintaining healthy vehicle inventory might hint at a different reality. Way too much inventory because people aren't buying these anymore. Why are they not buying these anymore? Lending standards have increased, so they aren't able to. They have too much debt, can't take it on, or they've lost their jobs. They're making a conscious decision to cut back the budget. Various reasons, things you typically see in an economic downturn are occurring. How about this? This is from Game of Trades. It says, caution, housing defaults have skyrocketed. This is unlike anything we've seen in a decade. And here they're showing the delinquency rate of multifamily housing up to rates that we last saw in the middle of the great financial crisis. It says the Fed has been on an unprecedented hiking cycle since 2022, taking rates from near zero to 5.5% in just 1.5 years. We just talked about that. It says interest rates have now been above the 10-year Treasury for the longest period since the 2007-2008 financial crisis. This indicates tight monetary policy. High rates negatively impact the housing market, given the high rate sensitivity of that sector. During the recent hiking cycle, 30-year mortgage rates broke out of its downtrend line and rose from 2.65% to almost 8% by 2023. Such high rates made the housing market extremely unaffordable. Homebuyer affordability fell to the lowest level seen in 35 years. So homes are less affordable today than they were leading up to the biggest housing bust in history up till then, right? I think we're about to see one bigger. We know how that turned out. It says mortgage demand also plummeted as high borrowing costs caused demand destruction. As unaffordability grew and high inflation put pressure on consumers, defaults started rising. The delinquency rate for multifamily housing hit levels unseen in a decade. Even now, people don't like buying homes. Buying conditions in the U.S. housing market have collapsed, now reaching levels only seen 2 times since 1960, 1974, and 1981. Currently, there's a 63.5% chance of a cut at the next Fed rate meeting, a 36% chance of a 50 basis point cut. That means the September rate cut is nearly guaranteed at this point, which should potentially provide some relief to the housing market. However, trouble for the housing market might still not be completely over. If a recession unfolds later this year, that would be another major headwind for consumers and the housing sector. And yes, it would. And you know what else would be a major headwind is this. So this is, we've looked at this before, the home price to income ratio. So what is the median home price compared to the median household income ratio? And as you can see right now, it's at 7.74. So meaning it takes 7.74 times the median income to buy the median house. To put things in comparison, at the most unaffordable of the housing boom that led to the great financial crisis, it was 6.79. And of course, through much of history, it was around 4, 4.5 or 5. This is, it's a big bubble, guys, and it's set to pop. We have bubbles in real estate. We have bubbles in the stock market that are all about to be popped. Read here from Britt, ETH. He says in 13 days, and again, this was from September 5th. So he means on the 18th. We'll put it that way. On September 18th, the Fed will likely make its first cut of this cycle. I've overlaid past rate cut years on top of the current NASDAQ chart, 1990, 2001, 2007, and 2020. As shown in the bottom two charts, these 4 cutting cycles match the economic data that we're currently seeing. Unemployment rate curving up, U.S. economic indicator curving down, the yield curve is no longer inverted, etc. The softest sell-off out of these 4 was 1990, with a 24% decline in the market after cuts. As shown in 2000, the NASDAQ went up 22% after the cut, before it fell more than 50% more. It's worth noting it was already down 54% before the first cut. Will this time be any different? No, it won't be any different. We talked in Saturday's video on the Substack about a big stock market crash is coming. History tells us when this takes place, we see this un-inversion, the type of un-inversion we just saw on Friday, that it's going to lead to a decline of anywhere from 24% to 80% in the value of the stock market. We don't know exactly how big that decline will be yet. Time will tell. We don't know exactly when that decline will begin. Has it already begun? Will it begin 2 months from now? But we know it's coming. That's what history tells us. So why is all of this important? Why is it important to see this flashing alert, this economic indicator that we've been talking about for a long time and saying, watch this. When it goes positive, that's the sign that we're very, very, very near seeing these headlines about crashing stock markets and mass layoffs. Well, why is that important? Why is it relevant to Bible prophecy? It's relevant because of this. So if you remember this article from August, it was titled, How the Current Global Financial Crisis Leads to Biblical Tyranny in 10 Steps. Guys, we're in the financial crisis. I believe it began sometime in late July, early August. We certainly saw that emerge into the headlines with the collapse, the largest 2-day collapse in Japanese stock market history. As this article points out, no matter what the Bank of Japan does, if it raises rates, lowers rates, no, it doesn't matter what it does, years and years and years and years of poor economic policy have led them to a point where no matter what road they choose, it ends in abject failure. It leads to a bad situation economically. We're seeing the continued volatility in the markets. We're going to see more and more as a result of this. We've talked about the yen carry trade in the past. We were talking about that leading up to seeing that unraveling back in early August. At that time, I said, this is not the end, right? All of that started when the Bank of Japan, or really the catalyst for that huge sell-off, was the Bank of Japan saying, we're going to raise rates 0.15%. Okay, and so by doing that, the yen carry trade is facilitated on this spread between Japanese government bonds and typically US government bonds, but it can be anything else that people could borrow the yen to buy. But just raising those rates closed that gap a little bit and caused that huge market sell-off. Well, the Fed cutting rates, which they're widely expected to do next week, also shrinks that spread. It's almost the same as if the Bank of Japan had hiked as much as the Fed is going to cut. And if that's the case, we could see they lower rates next week and reignite the yen carry trade, unraveling. And all the dislocations in global markets that we saw at the beginning of August, they managed to make people believe that all of those problems were solved then. They've been lurking beneath the surface. Guys, we're going to go through these 10 steps right here. We're going to see limited bank runs at first. We're going to expect to see a lot of headlines about glitches. There's glitches at the bank. The online banking was down, or took an extra 5 days for my deposit to go through. Who knew? It's a software glitch. It's a ransomware attack. It's a whatever it may be, the excuses they come up for, but it's going to be problems with the banks. Then we'll have that massive central bank response. They'll panic. They'll start cutting rates and bailing out banks and hedge funds and everything else until finally they get enough people saying, you can't do that. You can't keep bailing out all these banks. And they'll say, you're right. We'll follow the law on this one. And there will be a bank bail-in. If you don't know what that is, go check this article out. But that's going to cause mass panic, run on banks. Not saying all of this is going to happen this week, but this is what's going to play out most likely in the next couple of years. Hopefully, as born-again believers, the rapture is very near. We won't experience any of this. But regardless of if we do or don't, the world will experience this. Something big will blow up. They'll have the bank holiday we talked about many times before, and then they roll out the new system. And that's why this is relevant to Bible prophecy, guys. It's not because I just like to talk about financial matters. It's because this crashing system, the system we have, it's a big Ponzi scheme. It's a Ponzi scheme built on top of a house of cards and constructed on a foundation of lies, and it's going to topple down in the near future. And their solution is going to be, well, central bank digital currency. That'll enable us to regulate the banking system in a manner worthy of the 21st century, is what they'll say. And we could have prevented these frauds. You know, that Bernie Madoff guy that defrauded you out of your retirement savings? If with central bank digital currency, we would have known that he bought a lavish house in the Hamptons and a yacht with the cash you gave him instead of buying Exxon stock or bonds or whatever else. So if we have central bank digital currency, we can prevent that from happening in the future. And, we know you lost your 401k, but we got this new tokenized assets system that'll make sure that never happens again. We'll give you central bank digital currency now, and you can go and buy those back and restore your 401k. But of course, somebody might steal your 401k, so we'll need to roll out this digital ID so we can verify that you are the owner of the 401k. And people will say, yes, help me. I lost my 401k, but I can have it all back. All I need is central bank digital currency, tokenized assets, and digital ID. Sign me up. So the world will demand this. The public will clamor for it. And what does that mean? Well, it means this system that we're looking at right here, composed of those three elements, is functionally the equivalent of the mark of the beast system. It will be able to control who buys and sells. It will have surveillance into every transaction on the globe. Doesn't mean that it is the mark of the beast system, because the mark of the beast system requires the beast, the Antichrist, the false prophet, requires the tribulation. We're not in the tribulation. We right now don't know who the Antichrist or the false prophet are. But this system will be put in place as a result of this crisis. And then when the tribulation does occur, and the Antichrist and the false prophet want to create the mark of the beast system, they don't have to create it from nothing. It's already here. People willingly signed up for it, and they'll just flip a switch. Well, from now on, if you don't worship the beast, you can no longer buy or sell, just as we read in Revelation chapter 13, verses 16 through 17. Guys, that's where we're headed. We're in the early moments of this financial crisis right now. It's going to ratchet up in the weeks and months ahead. I don't know exactly how long it takes, what each step is along the way, or whether step 5 comes first, or what it may be. But the end destination is what the Bible says. We're going to end up with this mark of the beast system. I believe it's as a result of the crisis we're in now that most people are still unaware of, but they will come to be aware of it very, very soon. What we saw happen on Friday with that un-inversion is our sign. It's a signal telling us that we're going to see very soon crashing stock markets and mass layoffs, unfortunately. But guys, don't be afraid of any of that stuff. If you know Jesus, then that's all that matters. You've built your life on solid rock if you built your life on Jesus. But if you built your life on the security of a 401k or a bank account or anything else, then yeah, your house is on shifting sand. So make sure you know Jesus. That's why all of this matters. That's the only thing that matters, is that you know Jesus, and that you know that while we were still sinners, he went to the cross and he died for us. He paid the price for our sin so that we could have eternal life, so that we could be with God, reconciled with God, and in his presence for all of eternity once we leave this world. Guys, that's the good news. We'll be on the lookout for this. It's going to be an interesting week and month ahead to see what happens September 18th. They're going to cut these rates. The expectation is, oh, everything's going to go wonderful. The stock market's going to surge. Soft landing for the economy. And the stock market may surge for a few days, maybe a couple of weeks. But history tells us from there, it goes down 24 to 80%. It's not going to turn out well. So let me know what you think. Maybe I'm totally wrong. If so, leave your comments below. Make sure to hit the like, share, and subscribe buttons. And God willing, I will see you on Wednesday. Bye. If you want to learn more about the end times and Bible prophecy, make sure to visit my Substack at brittgillette.substack.com. There you'll find my latest videos and articles, as well as notes, where I share the latest news headlines, the articles I'm reading, and the videos I'm watching. Subscribe for free, and each new post on Substack will be sent directly to your email. Just scroll to the bottom of the homepage and hit the subscribe button. As an added bonus, your first welcome email will include a link to a copy of my free ebook, 7 Signs of the End Times. Also, make sure to check out all of my books. Just look up Britt Gillette on Amazon, Barnes & Noble, Apple iBooks, Google Books, Kobo, or anywhere books are sold. Thanks for watching today, and until next time, keep your eyes fixed on Jesus, the author and perfecter of our faith.